Welcome, and thank you for joining us at today's webinar, Use It or Lose It. My name is Nancy Hearn, and I am a partner at Saul Ewing, Arnstein & Layer, and I work in our Personal Wealth Estates and Trust Practice Group. I'm joined today by my partner, Tom McGuire. Hey, Tom.
Hey.
Who is resident in the firm's Chicago office, and also by Dave Brown, counsel in our Philadelphia office. Hey, Dave. Tom, Dave, and I are among 23 attorneys in our Trust, Estates, and Personal Wealth Practice Group. We're spread among offices in Manhattan, here in Princeton, Philadelphia, Chesterbrook, Pittsburgh, Chicago, and yes, for all you people fleeing the high tax states, we have offices in Miami and West Palm Beach. Our firm is a very old one, and though our lawyers aren't as old as the firm, the members of this practice group have many years of experience, and that often makes a great difference in advising families. Before we begin, I want to tell you that this is a re-recording of a live webinar we gave on October 1st. We received several questions and we'll do our best to answer those questions during our presentation. However, if you have additional questions after listening to it, please feel free to email any one of us. The handouts that we distributed a week ago are also available on our website. Finally, I have to read this legal disclaimer. The provision and receipt of the information in this program is not legal advice, does not create a lawyer-client relationship, and should not be acted on without seeking professional counsel who have been informed of the specific facts. And with that, let's get started. Ironically, the pandemic, political divisiveness, market volatility, and historic low interest rates have created a unique opportunity for those with estates over 11.5 million, and also for those estates with more modest assets. The federal gift and estate tax exemption is at an all-time high right now, over 11.5 million for a single person, and over 23 million for a married couple. A Democratic sweep may happen in November, and if the Democrats gain control of Washington, they plan to reduce the exemption to 5 million or less. In fact, Bernie Sanders' tax plan would reduce the exemption to 3.5 million. We may also see some states with large budget deficits track the federal government and go back to having an estate tax, like New Jersey, for example. The massive federal bailout also increases the likelihood of higher taxes. Tom, would you like to touch upon a few of the proposals that the Democrats have put out there?
Sure. So thank you, Nancy. In addition to decreasing the exemption, which Nancy just mentioned, there's always the possibility of actually increasing the estate and gift tax rates, which are currently at 40%. In recent years, they've been as high as 55%. And going back historically, I think we were closer to like 70% many years ago. So that's certainly an easy fix to raise revenue. A second option, or I give you a combination of some of these things, would be the elimination of what's called step up in basis. So what step up in basis is, so if you own an asset right now and you sell it, you will have capital gain based on the difference between what you paid for it and what you sold it for. What a step up allows is when an owner dies, the asset gets revalued at the date of death value, and that's the starting point for determining gain or loss. So let's say you had a stock that you paid $100 for, it's worth $500 now. you're still alive, you sell it, you have $400 capital gain. But if you instead held that asset until you died, that stock would now have a starting point of $500 for capital gain purposes. So if you sold it for $500, you'd have zero gain or loss. A step up is not available for all assets. The biggest example is retirement accounts, which will not get a step up in basis, but most other assets will get that step up in basis, and that could be eliminated. If there's a change in control of Congress and the White House. A third option is we may decide to tax unrealized capital gains when someone passes away. So we haven't done that historically, but some countries, for example, Canada, do that. So what that means is you look at the assets somebody owns when they pass away, how much gain has accumulated on those assets, and impose a tax at that time. So it's like an estate tax in that it's paid after someone's death, but it's a tax on the gain, not on the assets themselves.
Tom, I actually read that taxing unrealized capital gains is part of Biden's tax package. And it was proposed by President Obama in 2015. But I wondered about taxpayers, people who died, who had a single asset that was illiquid, say a residence that they'd held for 60 years or a family farm, and whether, what the impact of this, I think the impact could be harsh for some families. But
you raise a good point. I mean, certainly if you have all illiquid assets, then you have to pay a tax. It's similar to an estate tax situation where someone has a lot of illiquid assets in their estate and 9 months after death, they have to pay an estate tax. It may put you in a position where you have to either borrow money to pay the tax or liquidate assets fairly quickly, which is not the best scenario. But it may be that they could build in certain exemptions. So right now, for example, we have an exclusion of gain on the sale of a residence of up to $250,000 if you're single, $500,000 if you're married. Maybe something like that could be built into it where that portion of the gain wouldn't be taxed. But all of this really remains to be seen if that type of provision were put into the tax code. There are a couple other possible changes that, Dave, do you want to maybe chime in on these?
Sure, and these are, the ones that Tom was just talking about are mainly ways to raise revenue right away by just, increasing rates and just imposing taxes in a different way. These other changes are kind of aimed at certain techniques we might use to try to ease taxes or use the laws to our advantage currently. One of them that we'll hear about today is grantor retained annuity trusts. These have been discussed, or restrictions on these have been discussed for a long time. Nothing's really come about it so far. But one of the things you'll learn today is that they need to be successful. Grantor retained annuity trusts need to, one, you have to survive the term of the trust, and two, your assets have to increase at a certain value if you create a trust like this. And one of the things that's being discussed is mandating longer terms. Right now, grantor retained annuity trust can be 2 years, and they've discussed for a while making them longer. Another.
Dave?
Yes.
Dave? Excuse me, I was reading yesterday among the Democrats' proposals, and this again goes back to the Obama administration, that the remainder interest have a gift tax value of the greater of the assets contributed to the trust, or $500,000. So that would certainly impact a lot of grats going in. Right.
Yeah, because right now we, part of this is making a lot of the ways you use this, not exclusively, but one of the big things you can do here is make the remainder interest zero, and so that would force us, which actually when we use zero, we don't have to use gift tax exemptions at all to create these. If they force a value on the remainder, then some gift tax exemption would either have to be used or some gift tax would have to be paid. So that would be a huge difference for these specific grats. Another change that has been discussed is eliminating valuation discounts for transfers to intra-families or within families. And that's something we take advantage of a lot. If you're contributing a business interest or something like that, you can often get a discount for lack of marketability or lack of control, which allows you to transfer it to the next generation or whoever without using the whole value of the gift. So, it's using some portion of your gift tax exemption or paying some gift tax but not on the full value because you get a discount. And another kind of general potential change is eliminating the use of grantor trusts in general in connection with these kinds of wealth transfers that we're talking about today. And one of the common themes among the strategies we're talking about today is they're all grantor trusts. So this is, that a change like that would eliminate or at least force a new approach to all the things we're discussing today.
Thank you. So let's take a look at what these changes could mean. On the top left, you see current rules. Now, under current rules, we have an 11 for a couple. We'd have over $23 million exemption, combined exemption, and a 40% tax rate. So if they both died, if a husband and wife both died this year with assets totaling $25 million, the federal estate tax would be a little over $700,000. And going over to the top right, if the exemption amount was halved so that the married couple would only have a combined exemption amount of a little over 11.5 million, and the estate tax rate remained at 40%, the federal estate tax would be almost 5.4 million. And then at the bottom, assuming the same size estate, the exemption amount's been cut in half, and the estate tax rate goes up to 55%. The federal estate tax would be almost 7.4 million. Ouch. Okay, so why the urgency to act before December 31st? Acting now would allow gifts you make to avoid the effect of legislation passed in 2021 that would be made retroactive to January 1, 2021. The IRS position is that legislation passed in future years will not claw back to prior years. So you won't be penalized if you make gifts this year and the exemption is reduced in 2021. However, one cautionary caveat is that some states are taking a different position, like New York. So if you live in New York, you need to follow what's going on there very carefully in the next few weeks. Okay, we're going to focus on 3 strategies today, but before we begin, when we at Saul Ewing advise our clients, we do ask them one important preliminary question before we talk about the kind of strategy to implement, and that is, do you want to make a gift? In 2012, some clients gave away significant wealth because they were anticipating a lower estate tax exemption the following year, but that didn't happen. And some of them have had regrets, and many of them were angry with their lawyers. So to avoid donor's remorse, we're going to focus on gift strategies that take advantage of your current exemption without losing access to your assets. But before we get into this, we always ask a second question. Should you make a gift? Now this question has 3 parts. The first is, how much can you give away? Have you done a forecast of what you need to live comfortably for many years? Does your forecast take into consideration rising healthcare costs? You don't want to be in a position where, because of a change in your financial situation, a loss of a job, the stock market crashes, or there's a serious illness in your family, you find you need the assets you've given away. Tom, do you want to look at the second part of this question?
Sure. So once you decide that you can afford to give the money away is really the first question. Now we know how much you can give away with the exemptions. You could actually give more than the exemption if you want to pay gift tax. But the big real question is how much do you need to live on, to maintain your lifestyle? Once you get through that question, the next question is how much do you want to give away? And this relates more to how much you want your beneficiaries or donees to receive. So children, whoever, nieces, nephews, whoever that may be. So here, although you have the money to give away or the assets to give away, how much are you comfortable with, putting in the hands of a beneficiary, even if it's through a trust arrangement? People here need to think about things like, do you want to end up having trust fund kids, who really have no work ethic? If someone gets a lot of money that falls in their lap, it can change their lives significantly. So you really need to decide, what is the best amount to give to your beneficiaries and also the best way to structure it. So a lot of times it may not be outright distributions, it may be through various types of trusts and things like that, so that at least maybe you can maintain some control, make sure that, the kid doesn't just run off and spend all the money at once. So, and then once you get through that issue, the next question, Dave, you can answer the last part of this.
Sure. And okay, so this part is, you've decided to make a gift, you decided you should make a gift, and now you figured out how much you can afford to give away. And, an equal piece to this is now to determine, once you've gotten that far, is to determine which assets make sense to give away. And the assets, the specific assets you're choosing to give away could, take advantage of things like Tom was talking about earlier with the step up in basis. So you might be giving away, low basis stock, depending on the strategy you're implementing, or it might make sense to give away stock with high basis, or cash with its own, with no basis change. It also might make sense to give away or think about giving away interest in family businesses or something like that. And that's something that could take advantage, like I was talking about a second ago, about discounts. But sometimes people are hesitant to give away control or big portions of value of a family business that they spent their life building, and are uncomfortable to give it to the next generation or any other beneficiary, just because they still want to be in control, or they don't think that next person is ready to have that asset yet. So it's another piece of this puzzle is figuring out, not just how much to give away, but which specific assets to give away, depending on what you want to accomplish.
Hey, Dave, I think it's important just to point out here, just a simple rule is, typically if you give away assets, the person that you give those assets to takes what's called a carryover basis in those assets. So that means that stock I talked about earlier that was worth $100, you give it away. Although the gift is valued at the current $500 value, that beneficiary takes a $100 cost basis, which means when they sell the stock, then they will have that capital gain to report. Whereas if you give away assets at death and you've received that step up in basis, there's no negative income tax consequence to the beneficiary potentially.
Right. Thank you.
And of course, we all know that the amount of tax, both income and estate, is up for grabs next year. And so the decision-making will become even more complicated, perhaps. But let's say you've decided, okay, I'm ready to go. I'm able to give assets away. I want to give assets away, and I know what assets I want to give away. So let's look at a strategy now. Dave, would you like to talk about the Spousal Lifetime Access Trust with us?
Sure, I would. And yeah, so Nancy's right. This starts, this is one of the things that you can start thinking about once you've decided to make a gift. And this is a strategy that makes a lot of sense if for a person that has decided, like I said, to want to make a gift, but maybe and use a portion of their estate tax or gift tax exemption, but may not be comfortable losing complete access to the gifted assets. Of course, if you just make a gift outright to someone, those assets are no longer yours and you no longer have access to them. So this is something that still might work if a person doesn't want to lose the access to the assets that they gift. And what could happen is this spouses could create trust for each other. And the key here is, while they're uncomfortable making a gift and losing access to the gifted access or assets, they have to be very comfortable with the idea that the other person receiving the gift will use the assets appropriately and take care of the spouse. This is the key to this kind of arrangement. So it works better in some situations, and I'm thinking a situation like Matt Damon, who met his wife Lucia in a bar in Miami in 2003, and they've been together ever since, than it does in others. And that's something like Larry King, who's been married and divorced about 100 times. And though I'm not making any kind of opinion on which is better overall, I'm telling you that one is better for slats than the other is. So let's have the next slide, please. So assuming that's the case, our client Hannah decides she wants to use some of her exemption. She loves her husband Jake, and she really trusts her husband Jake. So she then could create a trust for Jake. And the immediate consequence of that is that she's done what we're really talking about here. She's used a portion of her current high gift tax exemption with whatever the amount of assets that she puts in the trust, whichever assets she chooses to put in the trust, those are valued and immediately uses her gift tax exemption. Those assets then also are removed from Hannah's estate for estate tax purposes because they're no longer hers. Also, by the way, as soon as she transfers the assets to the trust, so long as there's no what we call a fraudulent transfer, and that's something it's beyond the scope of this presentation, but basically it means if she's unaware of any kind of creditor claims against her that she's actively trying to get around by getting rid of assets, these assets transferred to the trust would no longer be accessible to Hannah's creditors. They also wouldn't be accessible to Jake's creditors because they're in trust for him and not accessed by him directly. The trust that Hannah creates for Jake could also provide for flexible distributions to Jake. This is what gives us the A part of this spousal lifetime access trust. So this is the access, which is distributions to Jake are his to use however he wants, which could include indirectly using them for Hannah. So Hannah now still has indirect access to the assets she transfers. So the results so far really are a kind of win-win in that Hannah's created this trust for Jake. She's used her gift tax exemption, which was the initial goal. The trust assets are available to Jake and indirectly to Hannah. The trust assets are protected from Hannah's creditors because they're no longer hers, and they're protected from Jake's creditors because they're in a trust for his benefit. And the trust assets are not going to be in Hannah's taxable estate, again, because they're not hers anymore. And the trust assets are not going to be in Jake's taxable estate because, at least to the extent they remain in the trust, he has no access to them and they're not included. One other thing to mention is that the trust for Jake could also include provisions that allow Jake to direct at the end of the term where the assets ultimately are distributed to. So after Jake's lifetime, he could provide in his own will or some other way something called a power of appointment. He could direct where these assets go. Could be to the next generation, could be to other beneficiaries, charities, anything like that. It could also be he could direct them back to Hannah. That would unwind some of this planning and put them back in Hannah's estate, but it allows some flexibility if the circumstances change before then. So now we have the next step is, because this is also successful, that Jake may decide that he wants to use some of his exemption too. And then so Jake could create a similar trust for Hannah to try to take advantage of Jake's big gift tax exemptions as well. And that way they both use some of their exemptions without losing access to all the assets. The key here is that Jake's trust should be similar to Hannah's, but they cannot be the same. So we're looking at something now called the reciprocal trust doctrine, in which the IRS and will look through a transaction like this if it's clear that it was just structured so that one person would give assets to another in exchange for that person giving assets back, and that, you know, aside from direct transfers like that basically the IRS is looking to unwind a situation like this where two spouses might make trust for each other just to take advantage of the rules if there's no difference between the trusts. So we need the trust to be similar to get the access we want, but we need them to be different also. And we don't really have any guidance as far as how different they have to be. So I think the answer is that they should be as different as possible, while still kind of getting the effect of allowing both spouses access and as much control as possible. So the differences to consider are different trustees, different distributions. For example, Hannah's trust for Jake might provide that income must be distributed to him. Jake's trust for Hannah might provide that the trustee has discretion of whether or not to distribute income and principal to to Hannah. Could have different powers of appointment. That's what I was talking about, with Jake having the ability to control ultimate distribution of the assets of his trust. It may be best for one trust to have that power, and for the trust that Jake creates for Hannah not to have that power. Just, you know, that's a pretty significant difference, and that's actually one that the IRS has weighed in on and said might be enough by itself to differentiate these things. And I think the most important potential difference for these things in connection with this presentation, when we're worried about potentially losing big gift tax exemptions, is timing. And one of the key ways to make these things look like they're not part of a plan is to space them out somehow. And timing is a good way to do that. So, you know, have one spouse create a trust as soon as possible, and the other spouse wait a certain amount of time to create the other trust. And, you know, that's a little bit, you'd like to space that out as much as possible. Here, when we're worried about exemptions that might be expiring and we're in October, you know, we don't have that much time to space them out, but still one trust created mid-October and another trust created mid-December would be better than two trusts created sometime in December.
Hey, Dave, I have a question. What if in this situation, let's say most of the assets were just in Hannah's name and Jake really didn't have much in his name? Are you still able to use both of their exemptions to take advantage of this planning?
Sure, yeah. And this is a good question. And this is another piece of the timing issue, I think, and that the initial piece here is that if most of the assets are in Hannah's name, spouses are able to transfer assets between each other with no gift tax consequences. So Hannah could transfer as many of her assets as she likes to Jake, and there's just no tax consequence to that. Once Jake has those assets, he can do whatever he wants with them, including create a trust for Hannah. Again, this is the timing issue, though, is that, you know, ideally you'd like as much time between those things as possible. So if, you know, we don't really want to track Hannah giving a big portion of assets to Jake just so the next day or the same day he turns around and puts those back in trust for Hannah, we'd like as much gap as possible. But the answer is yes, it can be done. And again, just spacing as much as possible. And another point I think here is you know, some people have asked whether trusts like these could be used for people that are in a same-sex relationship or, you know, aren't married. And those are two different answers. I think when you have people that are same-sex relationship, if they are married, then the exact same rules would apply. So you could still have the spouses transfer assets without any gift tax consequence between them. I think when you get into people that aren't married, regardless of same sex or otherwise, you could create these same types of trusts. You could no longer split the assets among them or between them the same way, because there'd be some gift tax consequence on that initial transfer. So, and then you also have the next piece of, typically these work because we're assuming people trust their spouses more than they trust, somebody that's not their spouse. That's clearly not true all the time. There are long-term relationships with people that aren't married, so these could work perfectly that way. It's just, the kind of the name they're given is based on the way they're most commonly used, not the only way they can be used. So I think so anyway, that was a long way to answer your question, Tom. Yes, that can be done. And
Thank you, Dave.
and sure. Assuming all this, assuming all of this is done, we have, what's the end result of this is that both Hannah and Jake have used their gift tax exemptions, which was the key for this. They removed assets from their taxable estates. They've protected their assets from creditors, and they have access collectively either directly from the trust that was created for them or indirectly from the trust that they created to the assets that they've transferred. So they've done this. They've basically taken advantage of their big federal gift tax exemptions without too much risk of losing access to those assets. And one last point to make on this is I've been asked about whether, right now when these exemptions are high at 11.5 or so, what happens if, even though there's some limited access, indirect access to the assets you gift, maybe the spouses still aren't comfortable giving away the full amount of the exemption. And what happens if, for example, they can give away, Hannah wants to give away $6 million today and not all of her exemption, but then the exemptions come back to 5 million next year or something like that. And the answer is that she, using more exemption now, would have no bad negative impact on her, but next year she'd have already used 6 million and the exemption is only 5, so she would have no exemption left, but there'd be no clawback or tax on that extra 1 million that she did use. That's kind of the point to try to use it now, just in case it goes back down.
Right. Thanks, Dave. Tom, do you want to move on to talk to us about a second strategy, a sale to a defective trust?
Sure, absolutely. Okay, so what I'm going to discuss involves what's called a defective trust. It's kind of a misnomer because there's nothing really wrong with the trust. Actually, it's a very good trust because it accomplishes what we want to do. But when we talk about a defective trust, or you might hear intentionally defective grantor trust, or sometimes there's an acronym IDGIT that you may hear. Basically, this is a trust where transfers to the trust are treated as complete for estate and gift tax purposes, which means it gets those assets out of the estate of the person who put the assets in the trust. But at the same time, for income tax purposes, the trust is treated as if the grantor, the person creating the trust, is still taxed on the income. So it gets the assets out of the estate for estate tax purposes, but the grantor continues to be taxed on the trust income during the grantor's lifetime. And because of this, basically the trust for income tax purposes is ignored. It's like the alter ego of the grantor. So there's no negative income tax issues. And it's probably easiest to illustrate this concept with an example. So let's say Gary Grantor owns a business called Sky High Botanicals. It has a true value of $15 million. Gary anticipates huge future growth due to high demand for his quote botanicals during the COVID pandemic.
Hey, Tom,
Yes,
are
Nancy?
the botanicals what I think they are?
I think you know what they are, Nancy. And right now with this polarized political environment, I think probably people need those more than ever. So that's why Gary thinks he's going to do well with this business.
Yeah, Scotch isn't working anymore, huh?
No, it's not, unfortunately.
Hey, Tom,
Yes.
what if Gary instead wanted to gift publicly traded stocks to the trust. Is there any way to take a discount under those circumstances?
Sure. So Gary can put whatever he wants into this trust. So by putting his business in the trust, let's say you can justify a valuation discount Dave mentioned earlier of, let's say, 30%. This is all determined by an appraisal, but basically the IRS allows you to justify discounts for lack of marketability because it's a, a non-public business, or lack of control if it's a partial interest and it's a non-controlling interest. So these factors allow the ability to take that valuation discount. So for tax purposes, the value of this business would be 11.5 million. But let's say Gary wanted to just do something with stock or cash, publicly traded stock or cash. Generally, those assets don't warrant any kind of a discount, but it is possible to create a discount. And the way you do that is put those cash, publicly traded securities, maybe real estate, into some form of an entity like a family limited partnership or a family LLC, and basically then do the transaction we're talking about using the partnership interest or the LLC membership interest. And because those entities likewise are able to justify lack of marketability, lack of control discounts, you're able to effectively create a discount where you wouldn't otherwise have a discount. So the way this works is first Gary creates the defective trust. We're assuming in this example that it's for the benefit of his children. And he does need to put something in the trust to start. So let's say he puts $500,000 of cash or publicly traded securities into the trust, or he could even put a partial interest in Sky High Botanicals into the trust to get it started. But there needs to be a taxable gift going in to use a portion of Gary's gift tax exemption. And the reason for that is when IRS scrutinizes these arrangements and the planning that I'm going to talk about here in a second, they want the trust to have some kind of independent significance apart from the sale transaction that I'm going to talk about. So by putting assets in there that are other than the transaction itself, that gives the trust some independent significance that justifies the IRS not being able to claim it's a sham type of a transaction. So the next step is Gary now sells the business to the trust for the discounted value of $11.5 million. And the nice thing here is because it's a defective trust, that sale to the trust itself is not considered a taxable event. It's treated as if Gary's selling the business to himself. If Gary had sold the business to an outside buyer, he would have to pay capital gains tax on the difference between whatever his cost basis may be and what he sold it for. But that is ignored because it's a defective trust. So effectively, now Gary has taken a business worth $11.5 million, and next slide, please. He's effectively frozen it through the receipt of a promissory note for $11.5 million. So now Gary has a static asset, a promissory note. The business is in the trust, it can grow, pay off income and all that. So Gary gets this note, and in my example, I have a note, it's a 9-year interest-only note with a balloon payment after 9 years. You're required to have a certain interest rate on a note, which is called the applicable federal rate. It's an IRS rate. Those rates are super low right now. 9 years is considered a midterm transaction. So for this month of October, that interest rate is only 0.38%. It's really beneficial. And this interest rate becomes relevant in much of the planning we talked about, particularly what Nancy's going to talk about in grant planning in a couple minutes here. So the note will pay Gary interest every year at that low interest rate. But again, because Gary and the trust are considered to be alter egos of one another, those interest payments coming from the trust to Gary are not taxable income to Gary. The trust doesn't get any deduction for it either, but Gary is not taxed on the income. And since let's assume Sky High is making cash distributions, they're going into the trust. or there's also that initial $500,000 that Gary put into the trust. Those assets can all be used to make those interest payments, which wouldn't be much of a stretch at such a low interest rate. So now let's say this trust continues to grow for the next 9 years. Sky High is doing well, so it's making periodic profit distributions to the trust. Also, the value of the stock itself continues to go up in value. Those profits or distributions from the company to the trust, again, are not taxable. Well, not again, but because it's a grantor trust, Gary pays the tax rather than the trust. So what that means is even though the trust is accumulating this income in it, Gary is paying the tax, which allows the trust to grow on a tax-free basis. And likewise, if the company were to be sold, Gary would pay any tax on the capital gain, which would allow additional accumulations for the children since the trust itself is tax-free. And the important thing here is effectively Gary's payment of the income tax is like a tax-free gift for the benefit of his children. The IRS has ruled that even though Gary is paying the tax on income that he's not receiving, the trust is receiving, that is not considered an additional taxable gift. So it's a really nice arrangement.
I guess my question, despite the, you just explained the potential gift and estate tax benefits of Gary paying the income tax here because it's a grantor trust, but I know people might get tired of paying tax on income they're not receiving. And is there something that Gary can do later on if he gets tired of paying this income tax?
Sure, Dave, that's a really good question, and I hear that question quite a bit. So there's a couple ways that we handle that issue. First of all, we would typically include in the trust a tax reimbursement clause. What this clause says is that the trustee may, but is not required, to reimburse Gary for any income tax that he pays up to the amount attributable to what those assets in the trust have generated. So it allows Gary to get reimbursed for that tax that the trust otherwise would have paid. It can't be mandatory, but if Gary has a friendly trustee, this mechanism is there that would allow the trustee to do that reimbursement to make Gary whole effectively. Another way to handle that is we typically include in the trust what we call as a power of substitution, which, wait, where am I going with it? So to back up, I'm sorry, I lost track. So in order for the trust to be a grantor trust, there are certain trust provisions that would be included that would make it into what's called a grantor trust. One of those powers is if Gary retained a power of substitution over assets in the trust. What that means is Gary retains the right to swap out assets from the trust at any time by substituting assets of equivalent value. We can include the ability to do what we call a toggle, so toggle on or toggle off that power. What that means is if at some point Gary relinquishes his power of substitution, or maybe you have a trust protector that is able to turn that power on and off, basically what you can do is, particularly this can be useful if you're going to have a large income recognition event, like a sale of a business where there's going to be a big gain and Gary doesn't want to pay the tax. You can toggle off the grantor trust power before that sale actually happens. And what the result is, the trust then becomes a non-grantor trust, which means the trust itself pays the tax on the gain. So those two things together allow Gary to achieve what he wants to achieve depending on the circumstances. Sorry for that convoluted answer, but next slide, please. So then after 9 years, let's say that note from the trust becomes due, the balloon payment becomes due. Hopefully the trust has accumulated assets that can be used to pay off that note. If necessary, and let's say the company hasn't been sold, part of that stock can be transferred back to Gary in satisfaction of the note. Again, no gifter's income tax consequence to that. Of course, now when you're transferring back, you're not transferring 100% back because the business has grown. So now you only need to transfer back $11.5 million in value. So the rest of that value is trapped in the trust and passes to the children, free of any estate or gift tax. So then finally, to round out this example, let's say Gary dies 15 years after the trust is created. The value of the trust is now $30 million. Gary, of course, received back that $11.5 million when the note became due. So effectively, in this example, $18.5 million would have passed estate and gift tax free to Gary's children. And at the current estate tax rate, that's a savings of $7.4 million, which is a really good result. Okay, so next slide, I want to talk a little bit about, one thing, the use it or lose it concept here, and what happens if there's a change in the White House and the Congress, or whether if there isn't a change. So let's say Republicans retain all the control. They're likely not going to be reducing exemptions or increasing, the rates or anything like that for estate tax purposes. So your planning's still good, but now you want to probably focus on income tax. So now you have assets, particularly the company that is in the trust, and it's increased in value, so that when it's sold, there is going to be some capital gains tax. What we can do here is Gary can now swap out some assets of his own, hopefully assets that have a high basis, so that there's not a lot of built-in gain, and he'll swap it out and pay off the note effectively. He receives the note back, but then since he owns the note, and he can then just extinguish the note. I mean, you're not going to owe money to yourself effectively. So the note is effectively extinguished. The value is still in the trust, but now it's high basis assets in the trust rather than low basis assets. And Gary has the high basis asset, the business, back in his estate, so that when he passes away, you get that step up in basis. So you've been able to maximize the income tax side of it. Well, now let's say the Democrats come in and you're worried that the gift or the estate and gift tax exemptions are going to decrease. What Gary can do in that example is he can just make a gift now. He's only used $500,000 of his gift tax exemption up until now. So he still right now has that, the full larger amount available. So he can use 11.5 million to basically, he can forgive the note effectively. He'd have to file a gift tax return to report that gift, but now he's locked in the use of that gift tax exemption. He doesn't have that note in his estate anymore. So that's good gift tax planning in that circumstance. And meanwhile, hopefully you've gotten that accumulation of value in the trust to still receive those benefits. I think there's one more slide for me. It's just kind of I don't know what you call these Venn diagrams or whatever. An illustration of what I just talked about, what your options are if the Democrats control versus what the Republicans control. But as you can see, particularly if you have an appreciating asset or an asset where you can get some good discounting, this sale to a defective trust might be a really good planning opportunity.
Thanks, Tom, and thanks, Dave. And now I'm going to talk about our third strategy. And this one is tried and true. A lot of my clients have made a lot of money for their families, and they are blessed by the IRS, unlike the strategy that Tom just talked about. This one is actually in the Treasury regulations. And it's called a grantor retained annuity trust, or a GRAT, as we like to refer to them. Now, a GRAT lets you freeze the present value of the asset you put into the trust and shift the upside growth to your beneficiaries, presumably your children. with little or no gift or estate tax. The success of the GRAT, as Dave mentioned earlier, is dependent upon two things. One, whether the performance of the assets in the trust is greater than the GRAT reference rate. Now, the GRAT reference rate is also called the 75/20 rate, and it's published monthly by the IRS. And right now, it's at an historic low, 0.4%. The second factor, which contributes to the success of the GRAT, is that whether you as the grantor outlive the GRAT term. The GRAT assets are going to be returned to you in the form of annuity payments during the term of the GRAT. But the appreciation, if any, at the end of the term passes to your kids tax-free. So it is a win-win if you don't need the appreciation.
Nancy, one of the things we talked about earlier was what assets to give away. Are there specific assets that make sense or don't make sense when you're specifically thinking about a GRAT?
Well, yes, but the decision is not, it's not a science, it's an art. Dave, I don't think it would be a very good idea for you to give away your Picasso, because over the term of the GRAT, we'd have to cut it into little pieces to make the annuity payments to you. For a short-term GRAT, I think these should be the racehorses in your portfolio. A stock you think is going to really shoot up in 2 years. It also may make sense for you to put a different stock in each GRAT that you form, depending upon how many you want to form and how much you want to give away. As to longer-term GRATs, I think these should be for your Clydesdales. Your tried and true stocks that, your blue chips, by way of example. And if you think that the blue chips will grow over a 10-year period, those would be the stocks that I think I would probably focus on for long-term GRATs.
Nancy,
yeah.
is there a benefit to doing shorter-term GRATs versus long-term? Are there risks to longer-term GRATs?
Yeah, and I'm going to get into that in a couple of minutes when I start talking about my example here. So if you just give me a minute, Tom.
Sure, sorry.
That's okay, that's okay. So you may want to fund, and incidentally, as an aside, you may want to fund a longer-term GRAT if you believe that the Democrats are going to get control of Washington. And we'll talk about that too. If you think that the market might become depressed over the next 8 years, you may want to think about a longer-term GRAT. But anyway, let's go to the example so everybody listening can understand how a GRAT works. To get started, you transfer assets into a trust for at least 2 years. That's the minimum term now required by the IRS. And suppose in October of this year, Fiona, who's down there in the little red dress, puts $5 million of stocks she owns into a GRAT with a 5-year term. Now, Fiona has the Midas touch, and she's formed several biotech companies, and recently formed a company that makes therapeutics for corona-type viruses. And she thinks her little company will be successful and is likely to be bought within 3 to 4 years by one of the major pharmaceutical firms. The company's now in stage 2 trials. So she is not married, but she has 2 adult children, and they're young adults, however. They're in their 20s. And so she says, okay, I'm going to put $5 million of my stock into a GRAT, and there you see in the illustration at the bottom, she's transferred $5 million of her stock to the GRAT, and the GRAT is going to pay her back an annuity, which is about equal to what she put into the GRAT over the 5-year term. And utilizing the very low 75/20 rate, which I explained earlier is 0.4%, the stocks are only expected to grow in the GRAT at 0.4% annually. But let's assume the GRAT's portfolio grows at 10% annually. At the end of the GRAT term, and if you look at number 3, the children are going to get over $1.8 million tax-free. Now, this might be a conservative assumption. I really don't know. But if it were, and the company was bought, and that $1 million becomes, that $5 million becomes $50 million, Fiona's 2 kids are going to be very, very happy. But Fiona may not want them to be that happy for all the reasons Tom talked about earlier. She doesn't want them to become entitled. She doesn't want them to take the money and go out and buy a Porsche and move to Monaco and live in the casinos there. She really wants these kids to have their noses to the grindstone. So she says, no, 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 it's going into a trust for their benefit. And that's the way it's going to be. And if they behave, they get some distributions. And if they don't get distributions. There we have Fiona. Now, getting into your questions about short-term versus long-term GRATs. As I said earlier, if you think that the value of what you put into the GRAT is going to skyrocket in the short term, you try to capture that growth and avoid future failures in performance that might happen over the long term, Tom.
Great, thank you.
If you think, as I said earlier, if you think the stock market might be depressed because of changes in Washington, you might consider a longer term GRAT with maybe a mixture of blue chip stocks that would grow over time. So I don't know, do you have anything else you want to ask me at this
No,
point?
I was wondering, do you think Fiona should get together with Gary and maybe merge their businesses? Maybe that might be a good answer.
How old is Gary?
I don't know, I think they're probably about the same age. They have 2 successful
Well, maybe
businesses. They
we
both
get-
have kids. It'd be like a Brady Bunch situation.
Maybe we'd earn a fee for that. What do you think? Anyway, I think that about wraps it up. Just like to say thank you to all of you who are listening, and thank you to the group. I think we had about 75 listeners a week ago, we were delighted to have such great participation. And also to tell you that we're here at Saul Ewing to help you. We're good listeners. We understand how you might be feeling right now, particularly during the pandemic and all this political disruption. And we're here to help you. And if you are anxious to do something with regard to making gifts, again, now's the time to do it. And we'd be happy to hear from you. Thanks very much.
Thank you.
Thank you.